Hey guys, Dave Keller here with Market Misbehavior. Recorded a video last week on my channel here talking about what a correction may look like. Talking about, we're looking at some of the different ways that markets can correct. Price corrections, time corrections, and stealth corrections. We looked at all those examples using the S&P 500 in the last year and a half or so. And if you missed that, I'd encourage you to watch that video first because it tells you a lot or should inform your thinking of how to answer the questions I'm about to pose to you today. What we're going to do is what's called the choose your own adventure style analysis. I'm going to review the S&P 500 and give you 4 choices. What do you think is most probable for the S&P and why? So today, it's choose your own adventure on the S&P 500. You know, when I was growing up, I loved choose your own adventure books. I loved the fact that compared to a regular book, which you read very linear in a very linear fashion, you actually had the ability to make different decisions and see how it impacted the characters and impacted the future path of the different characters in the story. I don't want to encourage what is a challenging behavioral bias called the illusion of control. You know, one of the things you have to realize as an investor is there are certain things within your control and certain things without our control. We tend to spend too much time thinking about what's out of our control. Things like the market direction, what the market's going to do today, what a particular position is going to do, etc., what the Fed is going to do. And we don't pay enough attention about things that are in our control, things like our routines, our decision-making process, what information we consume and when, sleep, what we do for fun, all those things that can impact our decision-making. So, illusion of control is basically that behavioral bias or that challenge where we feel that we have control over something that is uncontrollable, right? We feel that if we try hard enough, we could will the market or a position to do a certain thing. So I do not want to encourage that sort of thinking because it's a little bit irrational. We want to focus on what we can control. However, it's helpful to think about these different scenarios. And in my previous life at an institutional investment firm, we used to think a lot about different scenarios and how portfolios or positions would react potentially to different things. What if inflation went up or down? What if interest rates went up or down? What if the S&P went 10% higher or lower? What might that do? You know, how are we positioned for those potential future paths? And it's a really good iterative process to try to understand and anticipate how your portfolio might react to different scenarios. So before we get to the 4 choices and what they might mean for us, I wanted to remind you, if you're interested in this sort of thinking about market history, investor decision-making, and routines, price, breadth, sentiment, and the premise of technical analysis, if all that's of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this ride with us. Also, if you enjoy the video, give it a thumbs up, would you? We would very much appreciate that back. Finally, put a comment below the video as I outline this choose your own adventure and the 4 options. I would love for you to vote which of the 4 do you think is most probable and why. Let's get to the charts. All right, so choose your own adventure style. This is how this is going to work. We're looking at a chart of the S&P 500 for about the last 2 years or so. So we see the acceleration into the February 2020 market high, the sell-off of just over 30% to the low in March of 2020, the quick V bottom, the higher low in April, the rally into a bit of a hiccup in June, resuming the uptrend sideways September and October of last year before breaking to new highs again in November, continuing on making new highs every month to where we're at right now with a bit of a pullback going into Monday's close and a bounce higher on Tuesday. The question on everyone's mind, including my own, is what's next for the S&P 500. So the way that this works is this. We'll talk about the current environment. We'll talk about 4 potential future paths, 1 higher, 3 sort of lower, 1 higher, second one flat. The last 2 are more downward pressure. Outline each of the 4 scenarios and what you're voting on, and then put a comment below. Pick which scenario you think is most likely and explain why. It should be a lot of fun to sort of think through some of these different scenarios. And my hope is that you think about with each of these how it may impact your own portfolio, your own holdings. So I took a screenshot of the S&P. We're looking back at about the last year and a half or so, going to late 2019. And I have the chart updated through Tuesday, July 20th. I have a green line highlighting one particular point, which is around 40.50. That's the swing low from May. And I'm doing that because a couple of the scenarios actually involve that point, and I just wanted to make it clear what we were highlighting. So here is scenario number 1, what we'll call the bullish scenario. Basically, the argument here is that the bottom is in. We pull back to the 50-day moving average like we have done many times in the last 6 months. Most likely that's it. we retest new highs and somehow break higher, and we continue on, and we get up maybe another 10%, which would put us around 4750 or so, maybe a little bit higher than that, 4800. Let's put the objective there, and let's say over the next month or two, that's about what the chart of the S&P looks like. And I'm giving the very general squiggly line approach, but that is the general scenario of option number one, what we'll call the bullish scenario. The bottom is in, we find support at the 50-day moving average, and we rally and continue to strengthen on. Basically, this uptrend that we have been experiencing really is not stopped yet, and we continue to push higher, driven by stronger earnings, the recovery of the cyclicals, whatever it is, the fan mag stocks. It all just keeps working as the Fed does not step on the brakes anytime soon. That is scenario number one. Scenario number two, which we may call the range-bound scenario, is the top is in. We do not make a higher high than where we're at. We may chop around a little bit, but we're going to remain in general in this range, ranging between where we ended up last week, 44, 44.50, and down to around 40.50, which would be the swing lows from May. So basically, we break down through the 50-day, but we don't really break down through this key support level. If you watch my previous video talking about correction scenarios and what they may look like, we talked in particular about this 40.50 level, because so much, it's sort of the consensus view that we may have seen a top and that this is the support level. And there's so many people expecting it. I would not be surprised, no matter what, if we get down near that level, at the very least, expect a bit of a bounce as a result there. So option two, the range bound scenario, we don't really go much higher than where we're at. We don't go much lower than 40.50. We sort of stay in this 400% range, about a 10% range from the lows last May to the highs that we made just recently last week. Option three, which what we will call the, what will we call this? The minor correction, maybe I will describe this, is a bit deeper. This is more of a 20% sort of sell-off. This would take us down below where we're at. This tells us that we've sort of made the high. This bounce today was a bit of an aberration. We're going to continue lower. And sorry, I'm messing up what the chart could actually look like here. Let's say we do this. We bounce off of 40.50 as I would expect, but we don't make any headway. We break through the 200-day moving average. We get around to here. This would take us actually to the upper end of this range. That's about 20% off of the highs last week. That would certainly be a fairly destructive scenario, and I'm calling this a minor correction because it's not, it's not more than a 20% drop from the all-time highs. This would be less than the February to March 2020 pullback. It would keep us above this range here. This coincidentally would also be the first Fibonacci support level, 38.2% retracement of the March low to the July peak. So that takes us down to around, we'll say 3,600 or so. That'd be the upper end of the range, September, October. What's interesting about the scenario is think about what the individual charts, what the stocks and groups that make up the S&P 500, what they would most likely look like. Small caps have been struggling. What would those actually do given a further deterioration in the S&P to the extent that we're talking about? What would the fan mag stocks do, right? We have Apple and Amazon, which so far are doing a bit of a failed breakout routine. They would have to go well back within their range, if not continue a little bit further. What would happen to interest rates in that environment? Inflationary concerns. What would the Fed not be able to do, or this would be a disbelief in the Fed's ability to hold prices higher, or the Fed would be taking enough action or changing their language enough that people would expect to start to price in higher rates. So that is scenario number three, what I might call the minor correction. As you can guess, scenario number four is what we may call the doomsday scenario. This is basically saying same as number two, but we don't stop there. We continue even lower, and we sort of get down to around 3,000, maybe a little bit, undercutting that a little bit. That would take us, that would basically match the trajectory of the February to March sell-off, sort of a very similar sort of distance to that. It would basically be a replay of that. What would need to happen for that sort of scenario to play out? That would be, that negative of a scenario would have to be the Delta variant becomes much bigger of a deal than it appears like it may be now. Economic shutdowns have to come back in. They're just talking in the US about, depending on where you're at in the US, about re-upping some of the mask requirements in certain states. does that become a much more widespread thing? Do you have to re-shut down and go back to a period of social distancing to some large scale? Things like that would really cause the economy to reset and really hit pause on the economic growth that we've seen so far. That's what I would argue would probably have to take. It would have to be some exogenous event that would cause prices to go down that far, but it's possible. And that is what's important about these scenarios. Do I think that last one is possible? Absolutely. I would argue every one of these 4 scenarios is possible. The real question is, what is the most likely scenario? So that's it. The Choose Your Own Adventure Gauntlet has been thrown. It is now your opportunity to vote on which one of those 4 scenarios is the most likely. Which one do you see playing out here over the next couple months, and why? Option 1, the bullish scenario, we go up another 10% from current levels. Option 2, the range-bound scenario, we remain about a 10% range from 40.50 to 44.50, or very close to that. Option 3, we go down another, let's say 10-15%. We retest sort of that 3,600 level, the upper end of the range from September and October of last year. Option 4, the Doomsday Scenario, we replicate the sell-off from early 2020 and have a similar sort of pullback, most likely driven by some severe reaction to something that we don't know yet. Which of those 4 gets your vote and why? Put a comment below and let me know. Also, if you like the sort of thinking about investor decision-making, behavior, and charting, please subscribe to my channel. It'd be awesome to have you along this ride with us. Also, if you like this video, give it a thumbs up. We would very much appreciate it back. From everyone here at Market Misbehavior, I'm Dave Keller. Be well, stay safe. Talk to you again soon.